The investing public, and majorly those who have interest in investing in government securities, that the Treasury bonds and Treasury bills, are staring at a looming scrapping or death of the 364-day Treasury bill as the government focuses to manage a looming debt distress come May-June of 2025. That is occasioned by the huge volume of short-term instruments that are expected to mature during that period, and their redemption owing to the huge amount expected for the repayment of those maturing instruments, over 130 billion worth of Kenya shillings, then that has occasioned the Treasury to issue a proposal to scrap the 364-day Treasury bill as an alternative, considering that in the late year 2024, the government, through its proposed issuance calendar, had proposed to issue switch bonds for the same purpose, to spread out the maturing instruments to avert the looming financial distress by the government. We'll be looking at more details about that strategy and the specific figures relating to that distress after 3 seconds short break. So don't go away. In the meantime, give us a like to the video and engage us in the comment section as you share the video to another person. See you after 3 seconds short break. Welcome back, and thank you for your likes and shares. The most important aspect of this management strategy, we need to look at the figures and the charts, how those debts have been distributed. And as per this pie chart, 85.5% of the total domestic debts are held in long-term government securities. Those are the Treasury bonds. We have about 11.4% that is shaded in blue, all being held in Treasury bills, and a small percentage of about 3.1% that is shaded in green, that is in other forms of instruments. So considering that spread of 85.5% being in Treasury bonds and the 11.4% being in Treasury bills, and the fact that this distress that is being looked forward for management in June and May of 2025 relates to the Treasury bill, which merely looks like a small amount when presented in a percentage. When we look at the numbers, that is where we are able to tell of what amount is this that is causing the distress, and we compare it with the usual amounts that are collected by the government through domestic borrowing through the issuance of Treasury bills and bonds. Don't forget that the Treasury bills are issued on a weekly basis, while the Treasury bonds are issued on a monthly basis. So looking at this second schedule, we are looking at the total spread of the domestic debt, which currently starts at 50% of the total government debt. The total debt is distributed to domestic debt and external debt. The domestic debt at 50% of the total of about 10 trillion Kenya shillings is at 5.26 trillion Kenya shillings and is spread out as follows. The Treasury bills are holding 615 billion, while Treasury bonds are holding 4.6 trillion, while there is a small 17 billion that relates to government debts dating before the year 1997. Considering those figures, we can also look at the specific percentages relating to each spread, and as per this schedule, the last column, as per their repayment or maturity period, the instruments that are expected to mature in the following 1 year or in the next 1 year, and noting that this is a schedule that was done in June 2024, it points that 18% or 18.6% of the total amount is related to instruments that are supposed to mature and fall for redemption by June of 2025. And that is where the problem has been projected. it is expected that in June, May 2025, because of the huge maturity of short-term instruments, there are supposed to be a debt distress that is now being tried to be managed through the 2025 medium-term debt management strategy. And this strategy proposes two things. Either we go the route of switch bonds, which were proposed through the issuance calendar that was done last year, covering 2024-2025 issuance period. And in June 2024, that is when we expected the issuance of the switch bonds. And as per our analysis of what switch bonds, as per the channel in that time, those bonds were not issued. And therefore, it appears that the Treasury is now considering another option, which is the 364-day Treasury bill. To manage or get out of a particular form of debt is first by considering not to take any other debt of that particular form. If you want to be out of debt, you are first to choose not to take any other debt, then strategize on how you are going to clear the existing debts. Because a government cannot survive without borrowing. The government has identified the debts occasioned through the 365 4-day Treasury bills to be the debt that is occasioning the distress, and therefore they are looking forward to not getting on board more 364-day Treasury bills related debts. For that reason then, and also with the objective to deepen domestic borrowing through issuance of bonds, the government intends to start issuing medium-term bonds, that is 2 to 5 year old on 2 to 5 year maturing bonds in place of the 364-day Treasury bills. In particular, this is meant to tackle three forms of risks that are facing the government as at now. And the first one is to reduce the refinancing risks. The amounts that are expected to mature and fall for redemption, which is buying back by the government, which will involve the government paying back the last coupons and the capital investments by the investors by that time of May, June this year is so huge compared to what the government is collecting, and that brings in the refinancing risk. The government will be unable to collect that huge amount required to repay those debts without affecting the current interest rates and inflation. The second form of risk that is being addressed in this case is to maintain the reduced interest rate, or rather this poses an interest rate risk. If the government was to collect or to borrow that amount at once in order to take care of the redemptions that will be occasioned at that time, then that will not happen without causing an interest rate increase that will change the existing rates, and thereby the government will be paying or redeeming lower interest rates loans by borrowing at high interest rates. And that interest rate risk is what is being managed by scrapping the 364-day Treasury bill and issuing longer maturing instruments at the current interest rates, which are lower compared to the interest rates that were prevailing last year at the same time. The third risk to be untold through this form of management, debt management, is the foreign exchange risk. Some instruments that are held in foreign currencies, if they were to be redeemed in full at that time, it will pose a huge foreign risk. And for that reason, these two options, the switch bonds and the scrapping of the 364-day Treasury bill, will give a diversity of debts that are held in foreign currencies. And lastly is to promote intergenerational equity. This is not to bundle all debts relating to the government to one set of generation, but spreading these debts over a long period of time will have spread that burden over many years. Lastly, but not the least, is also to look at the nature or the effect to our money market fund, because the 364-day Treasury bill falls under the money markets, and that is where the money market funds are domiciled. Money market funds are designed and tailored under regulation to be invested in short-term near cash instruments that are traded in the money market. But also looking at the asset allocation schedules of various money market funds held by different fund managers, you notice that less than 50% is being held in government securities, and therefore the immediate change or in the money markets will not affect the current money market funds. However, going in the long term, we would also expect the regulator, that is Capital Markets Authority, possibly to bring an amendment to the regulation to stretch further the investment horizon of the money market funds from the current 18 months to probably 2 years, in order to rope in a part of the long-term government, the longer-term government securities to be possibly invested in the money market funds. Or rather, this one pushes the market or causes an imbalance when you compare the money market funds and the fixed income funds, which highly compete with the money market funds in terms of their markets, because the fixed income funds can be invested in any form of investment vehicle regardless of its horizon. Thank you for watching, and see you in our next video.